You're watching Old and Broke. We all want to believe we're the exception, that our stock pick is the next big winner, that our gut feeling, research, or connection to the company gives us an edge. You've probably heard someone say, diversification is for the know-nothing investor. It sounds smart, bold, even rebellious. But what if I told you that quote is being used against you by people who forgot to tell you the full story? Because the truth is, concentrating your investments in just a few individual stocks might feel like conviction, but statistically, it's often a shortcut to financial disaster. And that's not opinion. That's hard data across decades of investing history. Most people don't realize how common catastrophic losses are, how rare true long-term winners are, and how easy it is to end up with a portfolio that quietly sinks, never to recover. This isn't just a warning, it's a roadmap. We're going to break down why individual stocks are far riskier than most investors realize, how many stocks you actually need to reduce that risk, and why even today's winners often become tomorrow's cautionary tales. If you're holding just a few stocks right now, thinking you're playing it smart, this might be the most important thing you hear all year, because sometimes the riskiest move is thinking you're safe. Welcome to Old and Broke, where we talk real money for real people. No hype, no hedge fund jargon, just the cold truth that could protect your future. Let's say you've worked at a company for years. You believe in it, you've seen it grow, and now a big chunk of your retirement is riding on its stock. Or maybe you caught a hot tech stock early. Apple, Tesla, Nvidia, it soared. And now it's your biggest holding. On paper, you feel like a genius. But here's what no one talks about. That same success might be the biggest risk in your entire portfolio. When one stock makes up 10%, 20%, or even 50% of your investments, you're not diversified anymore. You're exposed. And the danger isn't just that the stock might drop, it's that you could lose a life-changing amount of wealth and never get it back. This isn't some rare horror story, it's painfully common. JP Morgan did a massive study on individual stocks. It's called The Agony and the Ecstasy. And here's what they found. 44% of all stocks in the Russell 3000 index suffered catastrophic losses of 70% or more and never recovered. Let that sink in. Almost half of all US stocks in that index completely broke their investors, permanently. And we're not just talking about shady penny stocks or random startups. Many were large, respected companies. Some were Wall Street darlings, until they weren't. Think about it. Enron was a market darling until it became a zero. Lehman Brothers was a titan until it collapsed overnight. Even GE, once the blue chip fortress, fell nearly 80% from its peak. When you concentrate in one or two names, you don't just risk volatility, you risk complete financial derailment. And here's the kicker. These catastrophic losses don't give you a warning. They hit fast. They hit hard. And once the damage is done, recovery isn't just unlikely. It's often impossible. If you've got a concentrated position, this isn't a scare tactic. It's a wake-up call. Because while you're hoping for a big win, statistically, you're walking into a field full of financial landmines. Diversification isn't just about playing it safe. It's about surviving. We love stories about the one that made it. The janitor who bought Apple in the 80s and retired a millionaire. The guy who put $5,000 into Amazon and bought a beach house. The early investor who held Tesla through every dip. And these stories, they're not just entertaining, they're seductive. They whisper to us, that could be you. But here's the truth, Wall Street influencers won't tell you. Those stories are the exception, not the rule. Let's look at the numbers between 1980 and 2020. 42% of stocks in the Russell 3000 had negative returns. That's not underperformance. They lost money. 66% of stocks trailed the market. 2/3 of investors could have done better with a simple index fund. And only 10% of stocks beat the market by 500% or more. Those are the so-called mega winners. Now flip that around. If you picked a few random stocks from the market, the odds that any of them becomes a mega winner? Slim to none. The odds that at least one crashes and burns? Almost guaranteed. This is called positive skewness. It means the market's total growth is driven by a small handful of stocks that explode upward, while most just stumble, lag, or collapse. So if your strategy is to pick the next big winner, you're not investing, you're buying lottery tickets. And here's the kicker. The stocks that have done well recently, the ones hyped on Reddit, YouTube, or TikTok, statistically, they're more likely to underperform going forward, not outperform. According to a 2023 study, stocks that were in the top 20% over the last 5 years, they had a negative return on average over the next 10. Let that sink in. Past performance isn't just a weak predictor of future results. It's often a red flag, but investors chase them anyway, thinking, if it's been going up, it'll keep going up. That's a powerful bias, and one of the most dangerous traps in investing. So if you're holding just a few stocks because they've done well in the past, you might not be holding tomorrow's winners. You might be holding tomorrow's headlines. Let's pause for a second. If most individual stocks fail, if even past winners often become future losers, then how does anyone build real, lasting wealth? The answer isn't sexy, it won't go viral, but it works. Diversification. Yeah, I know. It sounds boring. It doesn't get clicks, but it's one of the only proven strategies in finance that consistently protects wealth and grows it. Here's why. Every stock comes with its own risk. Maybe the CEO gets caught in a scandal. Maybe a new competitor shows up overnight. Maybe regulation changes and guts the business model. That's called idiosyncratic risk that's unique to a single company. And here's the thing. You don't get paid extra to take that risk. There's no reward, just exposure. Now compare that with market risk, the risk of owning the entire economy. You do get paid for that over time. So what does diversification really do? It removes the risk you don't need and keeps the exposure you want. Think of it like this. If you bet your future on one horse, you're gambling. If you own the racetrack, you win no matter which horse crosses the line. And the best part? Diversification doesn't lower your expected return. It lowers your risk. That's why it's called the only free lunch in investing. So, how many stocks do you need to be diversified? You've probably heard 20 to 30 stocks is enough. But that's based on research from the 1970s, focused on reducing volatility, not long-term outcomes. Modern studies go deeper. They ask, what's the chance you'll actually build wealth or lose it over decades? And the answer? You need a lot more than 20 or 30. Some models show that to meaningfully reduce your risk of underperformance, you need 200 to 250 stocks. That's why total market index funds are so powerful. They own everything. Winners, losers, every sector. You're not betting, you're participating. You'll never beat the market, but you'll never fall below it either. You get the return of the entire economy, clean, simple, reliable, and in a world where most active investors fail, that's not settling. That's winning. Let's redefine a word investors think they understand. Risk. Most people believe risk is just volatility, how much a stock bounces up and down. But here's the truth. Volatility might make your stomach turn, but it's not the real threat to your financial future. The real risk, ending up with far less money than you need when it's time to cash out. That's called terminal wealth, the amount you actually walk away with in the end. And this is where the old rules start to break down. Those studies from decades ago, the ones that said 20 or 30 stocks is enough, they were only looking at volatility, not what actually happens over the long haul. A 2022 study called How Many Stocks Should You Own? Looked at wealth over 25 years. They simulated portfolios with 5, 25, 100, even 250 stocks. The average diversified portfolio, it multiplied wealth 19 times over 25 years. But the real story was in the range of outcomes. With just 25 stocks, you had a 1 in 10 chance of ending up with less than 12 times your starting wealth. With 250 stocks, That worst-case scenario improved to 17 times. Same time frame, same starting amount, completely different outcomes. So yes, adding more stocks reduces volatility, but more importantly, it narrows the distance between the best case and the worst case future. It makes your future more predictable, more resilient, more real. Because when you're investing for 10, 20, or 30 years, what matters isn't how smooth the ride feels. What matters is whether you actually reach your destination. A concentrated portfolio might feel bold, but bold doesn't always build wealth. Sometimes it just builds regret. Diversification isn't about being conservative. It's about increasing your odds of having something to show for all the years you spent working, saving, and hoping. Let's talk about one of the most misunderstood forces in investing. Skewness. Sounds technical, right? But it explains why concentrated portfolios fail far more often than they succeed. Here's what it means. Simply, in the stock market, a small number of companies do really well. They shoot the lights out. They're your Teslas, your Apples, your Amazons. But the majority, they lag, they underperform, or they flat out lose. That's positive skewness. It's not a nice, even bell curve. It's a long tail of mediocrity, with just a handful of rockets at the end. And this matters a lot, because if you're only picking a few stocks, you're not building a portfolio. You're buying lottery tickets. Statistically, you are far more likely to end up holding one of the losers than one of the rare, unpredictable mega winners. Let's go back to the numbers. From 1980 to 2020, 84% of energy sector stocks underperformed the market. 85% of utility stocks trailed. Even in tech, where the big winners live, 73% of stocks failed to beat the market. So when someone says, just buy a few good companies and hold them forever, you've got to ask, how do you know which ones will be the good ones? Because even the companies that look great today might be the ones that sink your portfolio tomorrow. Some of the biggest blowups in investing history had strong buy ratings from analysts. They were large, profitable, widely respected. They didn't look like losers until they were. And even when you pick a winner, you might not win big enough to make up for the damage the other stocks are doing in the background. Skewness tilts the odds against you. And the more concentrated your portfolio is, the more that tilt becomes a cliff. The solution? It's not pick better stocks. It's realizing you can't outsmart the math. Maybe you're thinking, sure, most stocks fail, but I only buy the ones rated buy by the pros. It sounds smart, right? Analysts spend their careers studying these companies. They have spreadsheets, insider calls, Ivy League MBAs. They must know something we don't. But here's what the data says. Most catastrophic losses happened in companies that were rated buy right before they collapsed. That's not speculation. That's straight from JP Morgan's study, The Agony and the Ecstasy. They looked at companies that dropped 70% or more and never recovered. You know what they found? The majority of those companies were rated buy or strong buy just before the fall. Let that sink in. The stocks that wiped out portfolios were endorsed by analysts just weeks or days before the damage began. How does that happen? Simple. Analysts aren't fortune tellers. They're often biased. They're often conflicted. And many are simply late. Some work for firms doing business with the very companies they're rating. Others are pressured to stay optimistic because fear doesn't sell. And even the best models in the world can't predict the unpredictable. You can't model a rogue executive committing fraud, a sudden supply chain failure in another country, a government regulation that guts the business model overnight, a black swan event that blindsides the entire sector. But those things do happen, and they happen more often than anyone likes to admit. So trusting analyst ratings to protect your portfolio, that's not risk management. That's false security, and it's like installing a smoke detector and assuming your house can't catch fire. If you're holding concentrated positions because analysts said buy, just remember, they also said buy before Enron, before Lehman, before WorldCom, before every single disaster investors wish they could take back. And most people only realize that truth when it's already too late. Let me ask you something difficult. Are you holding on to a stock because it's a smart investment or because it just feels familiar? It's easy to believe we're making rational decisions. But most of the time, it's not facts guiding us. It's feelings. Welcome to the world of behavioral bias, the hidden force behind so many costly investment mistakes. Let's start with one of the biggest ones, familiarity bias. We trust what we know. We feel safer investing in companies we work for, interact with, or hear about constantly. You might own your employer's stock because you understand the business. You might load up on Apple or Amazon because you use them every day. It feels logical. But it's not insight, it's comfort. And comfort is not a competitive edge. Just because you like the brand or believe in the mission doesn't mean you understand the risks it faces. You're not in the boardroom. You don't see the debt schedule. Reddit threads don't count as due diligence. Then there's another trap, the illusion of control. This is when you believe that your research gives you more power over the outcome. I read the 10K. I watched the earnings call. I know this company better than Wall Street. But here's the truth. Even insiders get blindsided. Even CEOs are caught off guard. So what makes you think you can see what they can't? From behind a keyboard? It's not that you're dumb. It's that you're human. Humans are wired to overestimate what we know and underestimate the role of chaos. This is how investors end up stuck in concentrated positions. They believe they have an edge, but they're really just nurturing an emotional attachment. That's why people ride losing stocks all the way down. That's why they double down when things go bad. That's why regret so often replaces retirement. Understanding the math is only half the battle. The other half? Recognizing when your brain is tricking you. Let's say you did everything right. You picked a stock. It soared, maybe even doubled or tripled. Then it started to dip. Not crash, just slip. And suddenly your brain kicks in. I'll sell when it gets back to my original price. It's just a dip. The fundamentals are still strong. But what if it never comes back? What if that dip turns into a nosedive? And you're still holding, waiting, hoping, praying. Welcome to the disposition effect. One of the most destructive psychological traps in all of investing. It makes us hold on to losers too long, hoping for a rebound, and sell our winners too early, afraid they'll fall. Why? Because humans hate realizing a loss, even if the loss already exists on paper. We'd rather pretend it's not real. We'd rather stay in the game than admit we made a bad call. But it doesn't stop there. Let's talk about a few more traps. The endowment effect. You overvalue what you already own just because it's yours. If someone offered to sell you that same stock today, you wouldn't buy it. But because you already own it, you feel like it's worth keeping. The status quo bias. Doing nothing feels safer than doing something, even when doing nothing is the riskiest move of all. So instead of cutting your losses or rebalancing, you sit still, telling yourself it's long-term thinking. Representativeness bias. You judge the future by what just happened. If it's been going up, it'll keep going up. If it already fell this far, it has to bounce. But markets don't care about your logic. They don't reward stubbornness. They punish it. These biases don't just affect beginners. They sabotage smart people. They convince us to cling to a sinking ship because we don't want to admit the water's rising. So how do you fight back? Ask yourself, if I had this money in cash today, would I buy this stock again? Or better yet, would I recommend this to someone I care about? If the answer is no dash, that's your signal. Another tactic? Create a system. Start exiting gradually. Sell off a fixed dollar amount every month. Just like you dollar cost averaged in. You can dollar cost average out. It doesn't have to be all or nothing, but it does have to be intentional. Because the most expensive decision you can make is to do nothing. So maybe now it's sinking in. You're starting to see the risk. You're rethinking that one stock you've been holding on to for years. But then another fear creeps in. If I sell now, I'll get crushed by taxes. You're not alone. That's one of the biggest reasons people stay stuck in concentrated positions. They look at their unrealized gains and they freeze because nobody wants to hand over a chunk of their hard-earned money to the IRS. It feels like losing, even when it's the smart move. But here's the truth. Taxes don't disappear. The only thing you control is when you pay them and how you manage the risk in the meantime. Because if that stock crashes before you sell, Guess what? The tax bill disappears. But so does your wealth. You protected yourself from taxes, but you didn't protect yourself from loss. And that's the part most investors don't fully see. Sometimes paying taxes today is the cost of buying peace of mind, of moving from uncertainty to a solid, diversified foundation. Now, I'm not saying you need to dump everything all at once. There are smart, strategic ways to exit. Option 1, gradual exit. Sell pieces over time, monthly, quarterly, whatever feels manageable. It spreads out your tax bill and gives you room to breathe. Option 2, tax loss harvesting. If you have losses elsewhere, use them to offset your gains. That's how the pros do it. Option 3, charitable giving. Donate appreciated stock to a qualified charity. You get the tax deduction and avoid capital gains entirely. Option 4, gifting to family. In some cases, you can gift appreciated stock to a family member in a lower tax bracket. The gains are taxed at their rate, or not at all. What you shouldn't do? Nothing. Sitting on your hands isn't a strategy, it's avoidance. Because the bigger danger isn't the tax bill. It's waking up one day to find out the stock you were clinging to just broke your portfolio. So even if the tax sting is real, remember, you're not just selling something risky, you're buying something safer. You're trading uncertainty for stability, concentration for diversification, fear for freedom. So let's say you're still not sold. You've done your research. You're careful. You're not some Reddit gambler throwing darts at a meme stock chart. You've got a strategy. You follow the markets. You study balance sheets and watch earnings calls. But let me ask you something. If the professionals can't consistently beat the market, why do you think you can? We're talking about fund managers, people with degrees from Harvard, Wharton, Stanford, people with massive research teams, private meetings with CEOs, and access to data you and I will never see. And yet, most of them still underperform a simple index fund. Let's look at the numbers. A 2023 study found that only 45.2% of actively managed U.S. equity funds beat the market before fees. Add in the management fees, and that number drops even lower. Think about that. Even with all their tools, data, and experience, more than half still lose to the market. And remember, those funds are already diversified. They're not holding just 5 or 10 stocks. So if they can't win with diversified portfolios, what chance does a highly concentrated one-man portfolio have? Because here's what the research shows. Concentration doesn't just increase risk, it amplifies outcomes. When a fund manager is right, sure, they win a little bigger. But when they're wrong, they lose way more. And for most investors, that downside is where the pain lives. That's not a risk I'd want to build my future on, but I get it. There's something thrilling about thinking you found a hidden gem, that your homework gave you an edge, that you're the exception. But again, let's get honest. If the best in the business, with every possible advantage, can't reliably pick winners, what makes you think you can do it from your living room? Even when pros win, it's usually by a sliver. When they lose, it's by a landslide. So if you're still thinking you can outpick the market, just know the math isn't on your side. And in the next section, we'll talk about the alternative, the boring strategy that might just be the smartest move you'll ever make. In the final part of this video, we'll tie it all together. This wasn't just about numbers or charts. This was about waking up before it's too late. Let's be honest. At the end of the day, we all want the same things: security, freedom, a future we can actually count on. But too many investors confuse hope with a strategy and luck with skill. They build portfolios on stories, not probabilities. They fall in love with a stock and forget that even the prettiest company can break your heart. You might think you're being bold, but with a concentrated portfolio, you only have to be wrong once to lose everything. So here's the truth. Most individual stocks underperform. Many lose money. Some never recover. But diversification, that's not weakness, it's wisdom. You're not trying to beat the market. You're trying not to get beat by it. And that's a mindset built for real life, for real people, for real results. At Old and Broke, we don't chase hype. We chase resilience. And let's be clear, no one wants to end up old and broke. That name, it's not a destination, it's a reminder, a warning, a philosophy. It means live small, think big, sleep well, don't show off, don't fall for the noise, don't risk it all trying to get rich quick. It means grow wiser with age, protect your peace, and never let ego bankrupt your future. Because real money doesn't flex, it works, it waits, it wins. So if this video gave you something to think about, subscribe to Old and Broke. Share this with someone who needs a financial wake-up call. We're not here to sell you dreams. We're here to build durable wealth. One boring, powerful decision at a time. Stay sharp, stay diversified, and stay old and broke. In name only. You're watching Old and Broke. We don't predict the future. We just pay attention. Hit like, hit subscribe, stay sharp,